Many thanks for staying with us and welcome back to Business Week here on Arise News. Now, Nigeria's Monetary Policy Committee has cut the benchmark interest rate by 50 basis points to 26.5%, even as it retains tight liquidity controls. The CBN says the move reflects cautious confidence in moderating inflation and stronger external buffers, but the Apex Bank is urging caution. It also warns that recent gains, including external reserves at 13-year high of $50.45 billion, could be threatened by volatile oil prices and increased pre-election spending ahead of 2027. Joining us now to assess what this means for monetary policy, the markets and financial stability are Lawrence Amadi, who is partner and head of tech risk at KPMG Africa, and Dr. Patrick Ejumedia, who is head of research at Sterling Asset Management Trustees Limited. Gentlemen, welcome to the show. Great to have you. And, thank you for staying with us, Lawrence, and welcome to the show.
Thank you very much once again.
Dr. Patrick, great to have you with someone else today. As well. All right, let's begin with you, Dr. Patrick, because you just joined us. The MPC, we've seen cut benchmark rate by 50 basis points. What does this decision tell us about the CBN's economic trajectory?
Okay, so for me, basically, I think what it tells us is that the CBN is now saying that, it's high time we begin to look at real growth, given that the past monetary policies that they have done have yielded some significant results in terms of look at inflation. Like we said, it has drawn from its peak of about 33% to about 15%. That's high. And they've been able to manage exchange rates to give us that kind of high FPI inflow and control the external balance. But they also say, no, we don't have to cut too significantly, we have to cut with caution. So let's do a 50% because of some of the worry. So they are saying that it's not yet time to begin to do Thanksgiving. Let's wait for a while. But I think the major message to say that it's time to move in the path of real growth.
Absolutely. And of course, do it cautiously, which really has been the voice here. Lawrence, let's come to you. We saw the CBN maintain the cash reserve ratio at 45%. Now, from a risk and stability perspective, would you say this balance between easing and restraint is appropriate, and why?
So certainly, riding off Doctor's point, the cash reserve ratio is the one that the central bank uses to manage the liquidity out there. And if we have elections coming, you want to play safe. The businesses today, a lot of them, they need credit to thrive. They're all looking for, newer avenues and new opportunities, to do a lot more. And I think the CBN's measure, is a safe one. The banks are recapitalizing, and big signal for just having entities that will survive and give customers and give the Nigerian people confidence in what's going on in the system of the economy. So I think you would expect that for the stock market to keep the momentum with which we've seen. The cash reserve ratio, is one that we want to keep a decent lid on, just to have things smoothen out. I think I also must mention that as we look at the local CRR, we have to also reflect on the size of that market and how the market continues to rebound on all those policies. Doc talked about inflation. If you have inflation coming down, what that means is you potentially could start having a spiked demand again, and you got to just carefully just put a lid on some of those.
Right, and instilling that confidence is also very key, like you mentioned. So basically there are no flat thoughts about that. And speaking of that, the CBN also flagged the threat of oil price fluctuations and of course rising pre-election spending, which could possibly undermine the recent gains in reserves. Let's talk about this a bit more. How serious are these for macro fundamentals?
Oh, they are very serious. Very serious, but there's one thing you did not put into consideration. Suppose oil price goes up and inflation starts to rise in the US, and the Fed decides to increase their rates, their benchmark rates. What happens again? That's also a third scenario that you didn't put into consideration. But again, oil price is key because again, whatever happens to oil price is what to use our reserve that has hit 50 billion US dollars. It's because oil is also go up. Even oil has gone up, even despite the fact that we've seen other source of foreign reserve that has gone up. Diaspora remittance has also gone up. Non-oil export has gone up. FPI too has gone up. But oil is still the major source of FX. So volatility in that space is going to be some huge of concern in terms of being able to stabilize the exchange rate going forward, and it's also being able to tame inflation, because if you can stabilize the exchange rate, you can also control inflation. So that's key. On the other part, when you say fiscal, the part of the election spending, yes, of course, if it rises, liquidity at the moment is around, system liquidity is around 2 point something trillion at the moment. So if you rise, that's going to further increase that amount of money, and that's going to increase demand, that's going to increase inflation, that's going to reduce the real positive return that we have seen in terms of interest rates, and that can also discourage foreign investors that we have seen. So it's a serious concern, but my worry is for me to say that at a time like this, if there's a way we can begin to channel this election spending into, let's say, manufacturing, into agriculture, those can give us the real growth without necessarily affecting those macroeconomic fundamentals.
Which would you say is most threatening right now? I mean, I know that both of them, you basically can't do, they're both in tandem, but, just this morning we got reports of explosions in Iranian cities. Yeah. So which is more impending?
They are both. They are both, because if you look at it, they both will trigger inflation. One is from the domestic perspective, the other is from the international. Yeah. So they are both very important. Either way, they will still drive inflation.
To add to Dr. Patrick's point, I would also say, pre-election year, all of those credits that the banks give to politicians, they end up under consumables because it's all campaign. So if we're not investing in manufacturing, agriculture, or a productive means, major issue. So 3 things I would say is, I think if we are able to look at the reforms and religiously stick to the ongoing reforms through 2026, it'll be defining. Secondly, I think the government needs to think about what we do to the vulnerable in society. Because if you neglect the vulnerable, some people have warned that, you could implode if there's hunger and you're not dealing with it, and you're not creating jobs or creating things that will help, it could be a challenge. Third, I think they'll think about infrastructure. What are we doing on infrastructure spend? How are we trying to ensure that we create the platforms, that created. I mean, the last time we talked about the coastal road and how, we're creating activities, and as the road project carries on, real estate is going to, thrive and the likes. So I think all of those factors will play a key role. And then maybe lastly, if we think about subsidy removal, the power sector is a sector that, since Obasanjo's regime to date, we have constantly, talked about the revamp. The names changed, transmission has had the challenges, generation has had the challenges, the distribution has had the challenges. If we do what we've done with the telecoms sector for power, maybe we can also unlock another strong part. Yes, in the country.
Quite a myriad of considerations there, quite validly. But let me just stay with you on that as well. Given in light of all that we've highlighted here, what are some of the operational vulnerabilities that financial institutions particularly should be watching most closely if oil prices surge?
So the first big one I'd say is the credit portfolio analysis. I think today we've been heavily exposed to oil and gas. Yes, and with the concentration in oil and gas, like Dr. Patrick said, if anything happens to prices, or that market tanks a bit, the default rate is going to increase. We also, during COVID, CBN, forbearance allowed them to carry those loans without impairing them fully on their books. They've taken off the forbearance today. But the last thing we want as a country is to see any setback in this segment. Secondly, I think the measures, the other risk is all of these measures we have today, we have to pray that they keep holding, and that's why ALICO is so crucial to the country. Because if we were still importing PMS. Entirely without that refinery, we won't have 50 trillion. $50 billion in the FX reserves. So I think it's crucial that we have to protect this guy, protect the entity, because what's happening now is all of the downstream backward integration things that is happening with detergents. Yes, detergents, alternative materials for plastic, for manufacturing. They're all coming out of this refinery. And those are the things that would also, again, create additional ripple effects into the economy.
And one could also say that it's a great litmus test for what more could happen if we had an operational environment that also allows you to thrive, rather. Now, one would say external reserves at $50 billion, Dr. Patrick, this is for you, could provide about 9 months of import cover. Yet the CBN is being cautious about sustainability. How much comfort does this level then actually offer to investors and businesses?
So first, it's important that we establish that the foreign reserve is more like a stock variable, like what we say in economics. The most important part of it is the sustainability, which is the growth of it. So it's important that if it's remain at 50 billion or falls below, give us concern. But when it goes up, when it keeps increasing as it has been, then there's something we celebrate. But for many businesses, what they will be looking at basically is what is the accessibility to FX? And how can they predict it? And what is the stability of the FX? So those are the key issues that are paramount to an investor at the moment. So once they can assess it and it is stable and they can predict it, then business can thrive. So those are the concerns for an average businessman.
All right. I mean, you want to add to that?
I was going to say in 2025, to Dr. Patrick's point, in 2025, both Moody's and Fitch improved Nigeria's ratings. So again, that adds to investors' confidence, and if the remittances are up, FDIs are starting to rebound a bit because the currency is stable. And I think it makes a lot of difference, that if we keep getting this trajectory and we're heading towards an AA or A star sort of rating, I think it's better for the economy.
And what if pre-election spending starts to materialize faster than expected? What is this going to pressure the FX markets even further?
I think so. I think it will pressure the FX markets.
Because ordinarily what it will do is that it will drive liquidity up.
Yes.
Liquidity is already high, so it will drive it up. And when that goes up, what do you think will happen? Inflation would go up, like I said earlier. Imports will begin to increase, and that will affect our FX. And that will also remove this real positive return that we have seen that has been attracting investors to come in. So it's going to, and again, by the time demand goes up and demand for dollar goes up again, that will give us some concern for our FX. So it's going to be a concern, except like we have established, if those monies, those pre-election monies, in terms of campaign, have been channeled to productive means, into infrastructure, into manufacturing, into agric and all that. So we can then begin to see growth. Except that happened, it will bring concern.
And could this influence a reconsideration of policy stance in that case?
I didn't get that, sorry.
Would it influence a reconsideration of policy stance?
Yes.
If hypothetically,
I guess the question is, who are the policymakers,
Absolutely.
Right?
Yes.
If the policymakers are the guys trying to come back for 2027, then
so it's all conditional.
It's going to be a big if.
But they can also use that, even though it's the guys who want to come back for the 2027, they can, instead of just do the normal spending, consumption spending, they can begin to channel, we want to campaign, but we are doing it into this means, into agriculture, into infrastructure, into manufacturing, maybe some form of rebates for those who are going to manufacturing or into pure agriculture and all that, and you can use that as a form of campaign, and that can also play some significant role too.
Yeah.
All right. Quite a number of months ahead of us, and some very important decisions to be made. Let's look now at local markets. I'll come to you. I think I'm going to actually open this to both of you. Speaking particularly about bonds and equities, how are they likely to react to this mix of a rate cut and cautionary fiscal outlook?
If you look at the NSE or the NGX, like we call it today, we're ranking second in Africa, right after the Johannesburg Stock Exchange. I think the confidence, that the average, shareholder is building up on the system is a commendable one. Just before, stepping in here, one of your colleagues was saying to me, can I buy MTN shares? What do I think? Can I buy Dangote shares? I said, look, the future is bright right now for the markets, because if the Naira continues to strengthen against the USD, then invest away. Because the erosion in 2006 and in 2016, 2017 that we saw was the devaluation in the currency that was worsening the shareholder situation in the country. But we are seeing a case where we've gone from 1,800.
Sometimes 19.
Yes. And now we're in 1,300 plus range. It's huge. And I think it's big that we think about it. We're ranking ahead of the Morocco Stock Exchange, which is now third. And I think it's promising. So we should rally behind ours and buy the stocks in Nigeria.
It sounds like a no-brainer. Do you echo?
Yeah, so just to add to what he said, is to say that what is likely going to be the impact, you would likely going to see that the yield will be dropping. And when yield of bonds start dropping, what that will mean is that the new bond that government is going to be issued, they're not going to issue them at high stop rates, and that's not going to push up yield. So again, that means existing bonds with high yield are going to be more valuable. So, but again, with rates also coming down, you will now see some level of diversion to the equity market. Unfortunately, the day the CBN cut the rate, market dropped. And I think up to now, market has been dropping since on Friday. But I tell people, some people that have spoken with me, it's not because of that. It's because the market has gone high level of profitability since the beginning of the year. And so a lot of people are now beginning to take profit. Some people are attributing it to the fact that I said, no, it's not because of that. It's because the market has done significantly well, and some people are now beginning to take profit. So you see, like I said, existing bonds, with high yield will be very valuable. New ones, their yield, their stop rate is likely going to drop, depending on where the CBN perceive, what is CBN perceiving to happening to exchange rates. Depending on what the CBN perceives to happen to inflation. The CBN sees that the real positive return is being compressed. What it will naturally do is to not say, okay, let's increase it, rather than increasing the stop rate, the monetary policy rate that we have seen over the time. But we're definitely going to see a lot of activities, like he has said, happening in the equity market space.
All right. And speaking of that, I want to talk more about trickle-down effect now. For the common man, let's bring it down because we are talking a lot of technical lingo. Yeah. So let's look at the effect for businesses and households who are watching this entire policy shift. What practical implications should they prepare for over the next 6 to 12 months, for instance?
For my first step would be, we have to pay attention to security. Yeah. Because in all of this, if you look at the defense and security budgets, our budget is 53 trillion or thereabouts. Yeah. Yes, the defense and security budget is around 5.4 trillion, thereabouts, just knocking on, 10% of that budget. Food security becomes so crucial because, again, it is what powers the economy. If the average Nigerian, who we've seen today is, look, the number of Nigerians, below the poverty line, if those guys are not feeding or can't afford to buy food, we can create, a bigger issue for us. So it becomes the accessibility, the affordability, and just the stability for them becomes very, very pressing. And I guess that's why the politicians are able to easily use this these funds, because for the first time we look at the FAC allocations and we see how much the state governments are getting. This is an opportunity for them to say, look, how can we empower people and create things that can create means of livelihood? I think that's the real message for all governors, because governors are so powerful today. Yeah. And they're the one key source to ensuring that the states, the respective states, come above board.
Certainly, stability is very key.
No, of course, it's very key. Just to begin from where Mr. Lawrence stopped, is to say that, and that's the reason why we are saying that there's a rate cut, so that we can begin to see real growth. It is growth. It's only we can have real growth that we'll see growth that will trickle down. But then coming back to your question, if I say what would be this whole idea, what does it mean for a businessman? A typical businessman will be looking at, okay, how far or to what extent are banks able to transmit these cuts to increase loan to the business? So that becomes a concern. So they'll be looking at in the next 6 to 12 months, what's the level of credit to private sector that we'll be seeing? Is it going to increase? It's around 74 trillion as it is now, or $1 billion or something. So is it going to increase? So we're going to be monitoring that numbers, and that's what they'll be checking out for. Then again, they'll also be checking out for the inflation numbers. Is it going to go down further? In which case they'll be able to do business and all that. So I think those are the two main issues that they'll be checking. Then, of course, very paramount, exchange rate as well. The stability of it.
Yeah. Very, very important questions and necessary considerations as well. If you joined us midway, I've been chatting with Dr. Patrick Ejumedia, who is Head of Research at Sterling Assets Management Trustees, and Lawrence Amadi, who is Partner and Head of Tech Risk at KPMG Africa. Gentlemen, I want to thank you so much for a very insightful discussion, and thank you so much for joining us on Business Week.
Thank you for having us.
You're most welcome. Well, that's all we have time for on Business Week. I am Abby Owolawi. Let's continue the conversation on X, and do have a lovely rest of the weekend.